So, and that's what I was going to ask you too, because this is basically people invest into this and then you guys invest into real estate, apartment building, whatever it is. More pressure, right? You're taking other people's money and investing and working on these projects. How do you psychologically deal with that?
I think starting with St. Archer, where we raised money. So we took people's money to be able to start the company, and the type of risk that St. Archer was, real estate is a different type of risk.
Gotcha.
You're investing in an actual asset that is worth something. Regardless if you blow it, it's still worth something.
Right.
So there was a part of what I'm doing now that actually felt a lot more comfortable, where, there's investing is always risk, right?
Sure.
There will always be risk, but the type of risk that we're taking was more comfortable than the type of risk we took with St. Archer.
It's more calculated.
It's more calculated, and it's the upside or the potential for a big gain isn't there like it is with St. Archer.
Gotcha.
But with St. Archer, there was definitely a possibility where we lost all your money.
So explain that though. Explain that. If somebody, and do you just, how do you, is it word of mouth that people are investing into this, or how do people get involved if they want to get involved? Are you just taking, if somebody DMs you, do you just, how does it work?
Okay. So how it started, right? It started me going out to my friends and relationships that I built and told them about an opportunity that we were going to be doing and raise money the old school way.
Sure.
Right. And then as people come in and, they start telling their friends about it, there is this kind of grassroots growth that happens amongst your investor group. With social media, the more I started talking about it, definitely people started hitting me up through DMs or emails. The challenge there, and this has definitely been the hardest part about what I'm doing, is we're regulated by the SEC. Having government regulate a company the way they do was new to me.
Okay.
And so the SEC puts requirements on who can invest and who can't.
Interesting.
Oh.
So and that being what?
So right now, you have to be an accredited investor to invest with us.
Okay.
An accredited investor means if you're single, you make over $200,000 a year. If you're married or a partner, you have to make $300,000 a year, or you have to have a net worth over $1 million, excluding your primary residence, right?
And this is to protect the person investing, obviously.
This is to protect the person investing. So the SEC looks at it and goes, okay, Mikey, you have a social media following. People look at you as influential. You know how to use marketing to make things look good. We don't want you taking advantage of people that don't understand how money's working, right? So they put requirements, and basically their view is if you make a certain amount of money and you are able to generate that, you should understand how money works. So you should know the risk that you're taking on, right?
And a person that just makes $60,000 a year and wants to invest $40,000 and really can't afford that they're being protected as well, right? It's like you can't.
They are, but there are requirements on how much you can invest to what your net worth is valued at, right?
Gotcha.
So basically they put the rule at 10%. So if you're worth $100,000, legally, they don't really want you putting in more than $10,000.
Gotcha.
Did I say $100,000? $10,000.
Gotcha. Interesting.
So there's pros and cons to it, right? It's like, are there people out there that take advantage of people? Yes, I get that element of it. But guys, because people make a lot of money doesn't mean they know how money works. That was kind of an eye-opening experience for me. Like, these guys are making $2-3 million a year and have no idea how money works.
Right.
And then I have friends that are making, $75,000 a year, and they're like on it, manage their own portfolio.
Sure.
They're diversified. They're doing their thing. So there is a balance to it. But with all that said, we've only been able to allow accredited investors up until this point. We are now working on a new opportunity because in 2017, with the Jobs Act, they created a new offering that allows you to bring on non-accredited investors and bring the minimum investment down. So our current minimum investment is pretty high. So now it comes down to where pretty much anyone can participate. And then you have regulations on how much people can invest so that you don't take advantage for them or bankrupt them, et cetera.
Sure. Yeah.
You know?
Oh, okay. That's interesting.
So to your first question,
Please.
If I'm moving too quick, basically how it works, people invest into the fund.
Mm-hmm.
So all of the investors invest and own the fund together. The fund is valued based on all the assets that the fund owns.
Yep.
And so then it takes that capital, it goes out and buys, let's say, an apartment building.
Mm-hmm.
And then that apartment building basically has its gross income that comes in. You pay for your expenses, you pay your debt, and then the leftover money gets paid out to investors.
Right.
And then as the building appreciates, if there's a cash out refi or you sell, that distribution goes to investors as well.
Now, is this say I come in and I invest whatever? Let's just say $10,000, right? Is that $10,000 just going to that one asset, or is it a combined, like commune owns this and owns this and owns this? Do I own a piece of everything, or is it just one?
So there's syndication and then there's fund.
Mm-hmm.
So a syndication, or what syndicators do, is they'll find a property, they'll create an LLC, and then they'll raise money just for that property.
Okay.
And that is all you're invested in.
Gotcha.
A fund is what we do. You own a piece of all of it. Oh. So you buy in at the share price that's valued on total assets.
Yep.
And then you have a share in all of them. So you see a return based on how they all perform. So it allows you to diversify and kind of eliminate some of the risk by not just having all your money in one project.
Yeah.
And I say that because different areas perform differently in real estate, right? You have your coastal markets like California. We see these crazy appreciations, right? Projects don't cash flow here. And so you can have a project here in California where you can participate in appreciation. And then you could have a project somewhere in the Midwest where it cash flows.
Oh.
And then whenever there's a market correction, different areas respond differently to correction. So you're able to, be more risk adverse and participate in different types of returns. So that's why we do a fund.
Okay. Wow. Interesting.
Does that make sense?
Totally. I love it, man. I'll send you my PDF after the show.
Damn, Mikey.
No, it's amazing. It's amazing, and it is amazing too that you give other people opportunities to, invest in stuff like that. But man, I like I said before, I started off the question with like, man, that's a lot. For me, that'd be a lot of pressure, dude. Yeah, but you know what you're doing, though. It seems like.
Well, there's a couple things to it, right? One, if you believe in what you're doing, then it eliminates some of the pressure.
Okay.
When you don't believe in it and it feels risky, I think that would probably bring more pressure to you, right? So there is an element of, I completely believe in it. The majority of my assets are in it. And when people invest with us, my money is in it as well. You're investing with me. I'm not just taking your money and putting it out to work.
Right.
Okay.
Like we won't see you on like American Greed later.
No.
I love that show. No. It's a great show.
No. And then the other component, and I think which eliminates a lot of the pressure, is my three partners. One of them was my mentor since I was 20 years old. And all of my initial real estate investing was through them.
Oh, wow.
And so the experience they have is, it's 30-year plus experience. So I've been able to, when creating this, had people behind me to cover some of that experience that took some pressure off me, gave more confidence in investors that this wasn't just a startup.
So is Commune your full-time gig? Is this what you are doing right now? You don't have anything else kind of going on the sides?
This consumes everything.
That's okay.
My side is being a dad and a husband.
Sure.
Speaking of kids, you just had a new kid.
Congratulations, bro.
We got a boy. We did it for the boys.
We got
Hey. Congrats. That's rad.
Yeah. Thank you. So, the things I have on the side would be just passive investments.
Sure.
So with Villager, passive investment, I gave my capital to Josh. Same way, if you were an investor with me, you gave your money to me. You're not finding the buildings. You're not working on them. You're not managing anything.
Oh, I can't come and put a hard hat on and a little vest and like.
Look, if you wanted to, I've got places for you.
Okay.
That is 100% available.
Perfect.
So for Villager, I am completely passive. When it comes to Sovereign, at this point, I'm pretty passive as well.
Okay.
And then all of my time is put into commune.
Amazing.
Yeah.